Hello and welcome to the video for chapter 16. I'll put chapter 17 in a separate video so the videos don't get too long. So chapters 16 and 17 both cover variance analysis when we're looking at actual results to budgeted results. So we've already talked about our budgets. So our operating budgets, our production budget, budgeted income statement, and other supporting budgets. Well, our financial budgets are the cash budget and the budgeted balance sheet. Our variance is the difference between our planned results and our actual outcome. There are a number of different variances. Favorable variance means that we're increasing our operating profit, and an unfavorable variance is one that reduces operating profit. This example here, where we have our actual budget and our master budget, and the difference between the two is a variance. So for example, we sold 20,000 units less than we had budgeted for. So we have a 20,000 unit unfavorable balance. So our static budget is our budget for a single activity level. So this is our master budget. It's generally called a static budget. Well, the flexible budget is the budget that is for the actual level of activity that occurs. So in this last example, we had budgeted on the last slide, we had budgeted for 100,000 units, and our actual was for 80,000 units. So to look at the different variances, we would create a flexible budget for what would our results have looked at if we had written the master budget for 80,000 units. So we can compare the 80,000 to 80,000 results. This example then shows us what a flexible budget would look like based on those 80,000 units of activity. Then we can compare the actual budget to the flexible budget and get a better idea of if we had planned for the sales of 80,000 units, what would our results have been and what are the variances from those results. So our sales variance is just the difference between the operating profit in the master budget and the operating profit in the flexible budget. So that's our sales volume variance, which is also called a sales activity variance. That variance only exists because the actual number of units sold is different from the budgeted number of units sold. Then we have several profit variances. So we have a sales price variance, fixed production cost variance, variable production cost variances, and then marketing and administrative cost variances. And we're going to look at these variances individually. So we can see in this example here, and this is from your textbook, that we have our actual results, our flexible budget, and our master budget. And we're looking at the differences between those. So our sales activity variance is just the difference between the master budget and the flexible budget. So that variance occurs specifically because we sold 20,000 less units than we had budgeted for. You can see where our sales price variance is $40,000 favorable. That is because our revenue is $40,000 more. Our actual revenue is $40,000 more than a flexible budget revenue of $800,000. And we'll break these variances down even more. So many businesses have standard costs. I'm actually going to make this a little bit bigger so you can see the whole slide. So standard costs are our standard plan. This is what we use to make our budget. So for example, for this company here, we say that we need 4 pounds of direct materials for each unit. And we pay a price of 55 cents per pound. That's our standard cost under normal circumstances. So we take 4 pounds times 55 cents per pound to get a standard per unit cost for direct materials of $2.20. We also do the same exact thing for direct labor and variable overhead. So sales price variance, this is the difference between our actual selling price and the budgeted selling price multiplied by the actual number of units sold. So in our example from the textbook, we have an actual selling price of $10.50 per unit. Our budgeted selling price was $10 per unit, so that difference is 50 cents per unit taken times the number of units sold, 80,000 units. That's where we get that 40,000 favorable sales variance from. Our variable cost variance analysis, so we have our flexible production budget, our actual results on either end, and then in the middle we have our actual inputs at standard prices. So we break our variances down into a price variance and an efficiency variance. When we add together the price variance and the efficiency variance, they should equal the exact amount of the total variance. So our actual is actual price times actual quantity. In the middle, we have our standard price times the actual quantity. And then our flexible budget is standard quantity times standard price. And we use these same calculations for every single one of our variable analysis. So when we look at direct materials and direct labor and other variable rates, we're going to look at the price and efficiency variance and the total variance. So our price variance, our difference between actual price and budgeted price. We're going to look at this production cost variance. So we have the actual price times actual quantity. That's what our total sales were. Minus our standard price times the actual quantity equals the actual quantity times actual price minus standard price. That's what we did on that previous slide. So that's where we get the actual price of $10.50 minus the standard price of $10 times the actual quantity of 80,000 units. Our efficiency variance then is the difference between the actual quantity used and the budgeted quantity for the actual level of activity. So then we're going to take the standard price times the actual quantity minus the standard price times the standard quantity, or the standard price times the actual quantity minus the standard quantity. So we're going to look at direct materials variances, direct labor variances, and variable overhead variances. So our direct materials variances for this problem from your textbook, and I've left all of the numbers in here on the slides. So on the right, let's look at our flexible production budget. So our flexible production budget is our standard materials price times the standard quantity we should have used for direct materials allowed for actual output. So that goes back to that standard number chart where we look at, we say we're going to use, so we go back to the standard pounds, we're going to use 4 pounds of direct material at 55 cents per pound. So those are our standards. So we come here to our direct material variance, 55 cents times our standard quantity of 320,000 pounds. That's how much 4 pounds times 80,000 units is. Then we have the standard price times the actual quantity. So our actual quantity was 328,000 pounds. It means for some reason we used 8,000 extra pounds of direct materials. Now, this can be a variety of reasons, but it's one we probably want to investigate. One, did we have issues with our direct materials? Did we have a lot of scrap? Were there items that we had to throw away? Did we have waste, breakage, any of those other things? Then in the actual column, we have the actual price. We paid 60 cents per pound instead of our standard price of 55 cents per pound. So we might want to know, why was it more expensive? Did the price of this material just go up and we need to revise our standard prices for future periods? Or was this just a one-time thing where we ended up paying extra? Maybe our regular vendor had something where they couldn't meet our requirements. So then we get the total variance of direct materials is $20,800 unfavorable. And that gets broken down into an efficiency variance. That efficiency variance comes from using 8,000 more pounds of direct materials than we should have for normal production of 80,000 units. The price variance comes from the fact that we paid 5 cents more per pound than we had budgeted for. I'm going to pause that here and move on to direct labor with the next video.